If you are 60 or older and you have money sitting in a standard bank account right now, what I am about to tell you in the next few minutes is something your bank will never say to your face. Your financial advisor probably has not explained clearly enough, and that the IRS is absolutely counting on you not knowing before the end of this month, because there is a specific dollar threshold, a number, and if the balance in your checking or savings account crosses that number, you have quietly stepped into a category of account holders that the federal government monitors more closely, reports on more thoroughly, and in some cases flags for review in ways that most people in their 60s and beyond have no idea is even happening. This is not about doing anything wrong. This is not about tax evasion. This is not about anything illegal. This is about a system of financial reporting rules and account monitoring thresholds that were designed decades ago, quietly expanded several times since then, and that now sit directly in the path of millions of retired and near-retired Americans who are simply doing what they were always told to do. Save your money, keep it safe, put it in the bank. What nobody told them is that keeping too much money in the wrong kind of account at the wrong time can trigger reporting, flag your profile, and in certain situations create a paper trail that leads directly to questions from the IRS at the worst possible moment. I am going to walk you through exactly what the threshold is, exactly what happens when you cross it, exactly what the IRS sees and when they see it, and, most importantly, exactly what you can do right now, before June 30th, to restructure the way your money is sitting so that you are protected, compliant, and not handing the federal government an unnecessary window into your financial life. Stay with me through the end of this because the specific move I am going to describe in the final section, the one that most seniors have never heard of and that financial advisors typically only explain to clients with significantly larger portfolios, is something anyone can do, and it is something you can begin acting on this week. Before anything else, do something for me right now. If you have a parent, a sibling, a neighbor, or a friend who is 60 or older and who keeps their savings in a standard bank account, share this with them before you watch another minute. Not at the end, now. Because June 30th is a real deadline attached to a real reporting cycle, and every day between now and then that passes without action is a day that window stays open. One share, 10 seconds. It could make a genuine difference for someone who has spent a lifetime being careful with their money and has no idea a rule they never heard of is working against them right now. The threshold. The exact number you need to know. Let us start with the number itself, because everything else flows from understanding what it is and why it exists. Under the Bank Secrecy Act and the reporting guidelines that have been updated and expanded through the Financial Crimes Enforcement Network, commonly known as FinCEN, banks in the United States are required to file what is called a Currency Transaction Report, or CTR, for any cash transaction that exceeds $10,000 in a single day. That is the number most people have heard of. That is the number that gets referenced when people talk about not wanting to trigger bank reporting, $10,000. But here is what most people, and most seniors specifically, do not know. That $10,000 threshold is not the only number that matters. It is not even the most important number for the way most retired Americans actually manage their money. The number that actually affects the largest percentage of seniors is lower, it is less publicized, and it operates through a different but equally powerful reporting mechanism. Banks are also required to report what are called suspicious activity reports, or SARs, for account behavior that appears structured, unusual, or inconsistent with a customer's known profile. And the IRS uses a separate set of tools, including Form 1099-INT reporting, third-party data matching, and the updated financial account reporting rules that have been phased in since 2021, to build a comprehensive picture of any account holder whose balance and transaction patterns cross certain internal thresholds. For seniors specifically, the account balance level that most commonly triggers elevated IRS attention sits between $10,000 and $50,000 in liquid, non-retirement checking and savings accounts. Not because holding that money is illegal, it is not, but because at that balance level, the interest income generated, the transaction patterns typical of a retiree, and the combination of Social Security deposits alongside those balances creates a data profile that the IRS's automated matching systems flag for closer review at a higher rate than accounts with lower balances or accounts structured differently. The problem is not the money. The problem is where the money is sitting and what that position looks like through the lens of automated federal financial monitoring. What the IRS actually sees and when. Most people have a mental image of IRS scrutiny that involves auditors, letters, phone calls, and official investigations. That is the version that shows up at the end of a process. What very few people understand is what happens at the beginning of that process, before any letter is sent and before any human being at the IRS has looked at your account at all. The beginning of that process is entirely automated, and it runs on data that your bank is already sending without any action required on your part or theirs. It is simply how the system works. Every year, your bank files a 1099-INT form that reports the interest your account earned to the IRS directly. You receive a copy of that form as well, and your tax preparer uses it when completing your return. But here is what most people do not fully appreciate. The IRS does not wait for your tax return to see that number. They receive the bank's 1099-INT filing independently and run it through a matching program against your return. If the interest reported by your bank does not match what appears on your return, that mismatch is flagged automatically. If your balance is high enough to generate notable interest income, your account is in that matching pool every single year. What has changed significantly in recent years is the scope of what gets reported beyond interest income. Under reporting requirements that have been progressively expanded since 2021, financial institutions are now required to report aggregate annual inflows and outflows on accounts that meet certain activity thresholds. The specific numbers involved in those thresholds have been debated in Congress and modified through regulatory guidance, but the direction of the change has been consistent and clear. The federal government wants more visibility into more accounts, and the accounts that fall first into expanded reporting windows are the ones with higher balances and more regular deposit activity. For a retired senior with Social Security direct deposits, pension income, and a savings balance between $10,000 and $50,000, that description fits precisely. And the June 30th date that I referenced in the title of this video is not arbitrary. The second quarter of the tax year closes on June 30th. For banks operating under enhanced monitoring agreements with federal regulators, second quarter account balance snapshots and activity summaries feed directly into the annual reporting pipeline. An account that sits above certain internal bank thresholds on or around June 30th is more likely to appear in a dataset that regulators review during the second half of the year than an account that was restructured before that snapshot date. This is not a conspiracy. It is a reporting calendar, and it is worth understanding so you can make decisions that work with the calendar rather than against it. The specific mistakes seniors make that invite scrutiny. I want to walk through the 5 most common account behaviors among seniors 60 and older that, individually or in combination, increase the likelihood of elevated monitoring and IRS cross-referencing. None of these behaviors is illegal. All of them are understandable. But understanding why each one draws attention is the first step toward restructuring your situation in a way that does not. The first behavior is keeping large cash reserves in a single checking or savings account at one bank. This is the most common pattern among seniors who are raised in a culture that emphasized keeping money accessible and keeping it in one trusted place. The problem is that a single account with a high balance generates a concentrated reporting profile. Everything the IRS wants to see about you is in one place, updated continuously, and filed on your behalf by your bank whether you are paying attention or not. Distributing balances across account types and institutions changes that profile significantly. The second behavior is making regular, large deposits that are close to but below the $10,000 CTR threshold. This is called structuring, and even when it is entirely unintentional, it is one of the patterns that automated bank monitoring systems are specifically programmed to detect. If you regularly move money in amounts of $8,500 or $9,200 or $9,700, not because you are trying to avoid reporting, but simply because that is how your income or transfers work, the pattern can still trigger a suspicious activity report that goes directly to FinCEN and from there into federal databases. The intent does not matter to the algorithm. The pattern does. The third behavior is holding interest-bearing savings accounts without tracking the interest income carefully against what gets reported on your tax return. As I described earlier, the 1099-INT matching process catches mismatches automatically. Seniors who have multiple accounts at multiple institutions sometimes lose track of small interest amounts, fail to include them on their return, and generate a mismatch flag that results in an IRS notice. The notice itself is not a disaster, but responding to it requires documentation, takes time, and creates a correspondence record with the IRS that can influence how future returns are reviewed. The fourth behavior is keeping money that should be in a tax-advantaged account in a taxable account instead. Many seniors in their 60s who are not yet drawing down retirement accounts have significant balances sitting in regular savings that would be better structured in ways that reduce reportable interest income, provide more favorable tax treatment, and simply do not generate the same level of automated federal monitoring. The money does not disappear. It does not become inaccessible. It simply moves into a structure that is not feeding the same reporting pipeline every quarter. The fifth behavior is failing to use the FDIC insurance limit as a structural guide for how accounts should be organized. Federal deposit insurance covers up to $250,000 per depositor, per institution, per account category. Many seniors who have accumulated significant savings over a lifetime are sitting above that limit in single accounts without realizing it, which means they are both overexposed to bank failure risk and concentrated in a single reporting profile. Understanding how to use account categories and institution distribution to both maximize FDIC protection and restructure your reporting footprint is one of the most practical and underused tools available to people in this situation. What to do right now, before June 30th. Here is the practical section. This is what actually matters if you are sitting in this situation right now and you want to do something about it before the end of the month. I'm going to give you 5 specific moves in order of how quickly and easily they can be executed. None of these requires a financial advisor, although speaking with one before making significant changes is always worth considering. None of them requires closing your existing accounts immediately, and none of them involves putting your money somewhere risky or inaccessible. The first move is to calculate your total liquid balance across every non-retirement bank account you currently hold. Add up every checking account, every savings account, every money market account, at every institution where your name appears as the primary account holder. Write that number down. If it is above $10,000, you are in the monitoring window I have been describing. If it is above $50,000 in a single account, you are in an elevated position within that window. Knowing the number is the starting point for everything else. The second move is to consider opening a high-yield savings account at a federally insured online bank and moving a portion of your liquid balance into it. This accomplishes 2 things simultaneously. It spreads your balance across institutions, which changes your single institution reporting profile, and it typically earns you a significantly higher interest rate than a traditional brick-and-mortar savings account, which means your money is working harder while it sits wherever it is going to sit anyway. Many high-yield savings accounts at FDIC-insured online banks are currently offering rates well above what most traditional banks pay on standard savings, and opening one takes less than 20 minutes online with no minimum deposit requirement at most institutions. The third move is to review whether any portion of your liquid savings should instead be in a tax-advantaged vehicle. If you are 60 or older, you have access to catch-up contribution limits on IRAs and certain other accounts that younger savers do not. A traditional IRA contribution reduces your taxable income in the year it is made. A Roth IRA contribution does not reduce current taxable income, but produces tax-free growth and tax-free withdrawals in retirement with none of the required minimum distribution pressure that traditional IRAs carry. Neither of these vehicles shows up in the same reporting pipeline as a standard savings account because they are governed by a completely different set of IRS rules. Moving eligible dollars into these accounts before the contribution deadline is one of the most direct ways to legally reduce your financial visibility to automated monitoring systems. The fourth move is to pull copies of every 1099-INT form you received last year from every financial institution you hold an account with and compare the interest figures on those forms against what was reported on your most recent tax return. If you filed the return yourself, check the interest income line directly. If a tax preparer filed for you, ask them to confirm that every 1099-INT form was captured. A single missed $47 interest figure from a forgotten savings account can generate an automated IRS mismatch notice, and getting ahead of that kind of problem is significantly easier before the IRS raises it than after. The fifth move, and the one I want to spend the most time on because it is the least well understood among seniors, is to look into what is called a Treasury Direct account. TreasuryDirect.gov is a website operated directly by the United States Department of the Treasury that allows individual investors to purchase federal government securities, including I-bonds, Treasury bills, Treasury notes, and Treasury bonds, directly without going through a broker or a bank. Money held in Treasury securities is backed by the full faith and credit of the federal government. It is as safe as money gets in the American financial system. But it does not sit in your bank. It is not swept into your bank's deposit pool. It does not generate the same kind of account balance profile that a large bank savings account does. And in many current rate environments, the yields on short-term Treasury bills are competitive with or better than what most banks are paying on savings accounts. For seniors looking to restructure how their liquid assets are positioned before June 30th, Treasury Direct is a tool that most people in this situation have never seriously explored and that deserves attention. The one thing the IRS is counting on you not doing. Here's the truth underneath everything I've described today. The IRS is not targeting seniors. The federal government is not singling out retirees. The reporting systems I have described exist because financial transparency and tax compliance are legitimate government interests, and the mechanisms used to pursue them apply across the entire population of account holders. But what is also true is that the seniors most likely to be caught off guard by these systems are the ones who have done everything right for their entire lives. They saved, they were patient, they built up balances that represent decades of work and sacrifice. And now, those balances are sitting in structures that were designed for a previous era of financial monitoring, generating reporting profiles that those seniors have no idea exist before a quarterly deadline they have never been told to pay attention to. The one thing the system counts on is inertia. It counts on you not reviewing how your accounts are structured. It counts on you assuming that if you have not done anything wrong, you have nothing to worry about. That assumption is mostly correct, but not entirely correct, because the difference between an account structure that invites scrutiny and one that does not has nothing to do with whether you have done anything wrong. It has to do with how your financial profile looks to an automated system that processes millions of accounts and flags patterns, not intentions. You have time before June 30th to take the steps I described. Not all of them. Even one of them changes your position. Review your balances. Distribute where it makes sense. Check your 1099 reporting. Look at Treasury Direct. Talk to a tax professional if any part of this raised a specific question about your situation that requires a personalized answer. And do not wait until the deadline is behind you to start thinking about it. Final word. Everything I have described today is legal, documented, and available to every American regardless of income level or portfolio size. The moves that protect high net worth individuals from unnecessary IRS visibility are the same moves available to a retired teacher, a former factory worker, or a grandparent living on Social Security and a modest pension. The only difference is access to the information, and now you have it. If this gave you something useful, share it with someone who needs it, not as a favor to me, as a genuinely practical act of looking out for the people around you who are in the same situation and who have not heard any of this yet. The June 30th window is real, the reporting mechanisms are real, and the steps to address them are simpler than most people expect once someone actually lays them out clearly. Take care of your money the same way you took care of earning it, with attention, with intention, and without leaving it exposed to systems that were never explained to you. We will keep covering every update to these rules as they develop. Stay with us.